Elizalde with a quick take on the markets. After more than a decade building up those credit card balances, consumer debt has plunged. According to the Federal Reserve, the portion of our income that goes to pay credit cards and auto loans is at its lowest level since 1995. In normal conditions, this would be a good thing. But that is not what an economy built on how much we use our credit cards likes to see. After all, there is a good reason why you and I are generically known as consumers. Our mood is of great importance to business, and therefore it is measured with great sophistication by an index of consumer confidence. Either we consume or the economy grinds to a halt. The decline in revolving loan payments as percentage of income is even more remarkable when we consider that real income also fell. This means that the money set aside to pay off consumer debt has fallen even more in absolute terms than in percentage terms. This shouldn't be a surprise. Returns on various types of investments have collapsed. Interest rates on bonds have reached historically low levels, and dividend yields on stocks are not much higher and look highly uncertain. In this environment, the surest way to net 10% on your money is to pay off your outstanding credit card debt. Cancellation of debt may also go a long way to explain what people are really doing with their money. Although investors have flocked to bond funds, they didn't buy as much as they took out from the equity and money market funds they sold in the last year or so. The rest seems to have gone to pay off debts. The link between real disposable income and consumer debt service payments is quite intriguing. Apart from the sad fact that in real terms U.S. disposable income is 12% lower today than in 1980, the graph suggests that income may well continue to fall in the months to come. If this happens, people will continue to cut down on their revolving debt, which will further depress consumption, hit on banks' profitability, further discourage lending, and do nothing to improve job numbers. This negative feedback loop may be made worse by the widespread calls to reduce the U.S. deficit and cut back on stimulus measures that is going on right now. No wonder interest rates are falling, as a deflationary double dip, which once was considered to be a remote possibility, becomes increasingly credible. Since trying to revive consumption does not seem to be working, the thinking is shifting to different ways of dealing with this deflationary spiral. Some ideas focus on a significant retooling on the economy, redirecting government stimulus into infrastructure, green energy, and education, for example. The real objective of this would be to replace short-term consumption with long-term investment, therefore making the economy less dependent on a massively indebted consumer as its main engine of growth. This would amount to nothing less than changing the composition of U.S. GDP. Now, a shift of this magnitude may be too much for any country to pull off, even in the best of times, and other solutions may be more practical in the current political climate. But when stock markets volumes are in decline, personal debts are being cancelled, and everyone is stashing money in government bonds yielding rock-bottom rates, the conclusion seems to be that, unless something really changes, the stock market will be hard-pressed to find the floor. For more information, please visit us at www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.